Look at this sprawling subdivision. Dozens of brand new homes, built to catch the overflow of a booming population, sit entirely vacant. Across the Sunbelt, massive planned rental communities have become ghost towns. In cities like Nashville, corporate landlords are resorting to drastic measures to fill luxury high-rises. Some are handing out 3 full months of free rent on a 13-month lease just to get tenants through the door. Everyday sellers are feeling the exact same gravity. In Central Florida, a move-in-ready single-family home recently sold at a staggering $140,000 discount from what the previous owner paid at the market's peak. This chart illustrates where the buyers went. Historical mortgage applications have dropped 40% below their 2019 baseline. Overlaying overall homebuyer demand reveals a near absolute bottom, registering a dismal 5 out of 100. Buyers are rejecting current asking prices. Sellers, however, refuse to accept this reality. Frustrated by months of silence, a growing wave of existing homeowners are engaging in rage delisting, yanking their properties off the market completely rather than slashing the price tag. Millions of Americans adopted the mindset that a house is primarily a high-yield financial instrument, a guaranteed winner in a speculative spreadsheet game. Now, that exact mindset has gridlocked the entire real estate market, trapping both buyers and sellers in a standoff. The housing boom was built on a core assumption. States like Texas and Florida would experience endless inbound migration, creating a permanent shortage of homes and a constant upward pressure on values. But net domestic moving has dropped to decades-long lows. Builders who secured permits based on those peak migration numbers are now completing massive pipelines of inventory, delivering thousands of houses to markets where the buyers simply no longer exist. A secondary assumption held that the market would stay permanently starved for inventory because homeowners were securely locked in to sub-3% mortgage rates, giving them ultimate leverage to never sell. This chart tracks the status of current mortgage holders. The blue line is the dwindling share of owners with low pandemic-era rates. Watch the orange line cross it. Owners trapped in mortgages over 6% have officially eclipsed those holding sub-3% rates. These newer owners don't have the luxury of holding out. The cost of owning a home is rising faster than wages in many major markets. Surging property assessments, skyrocketing insurance premiums, and routine maintenance are draining bank accounts. Unable to weather the monthly expenses, a rising number of underwater homeowners are being forced into distressed short sales, asking banks to absorb the loss just to stop the financial bleeding. The math that fueled the boom has reversed. Theoretical assets on paper are turning into cash-draining liabilities in reality. The data explains the mechanics of the freeze, but it fails to explain why so many otherwise cautious buyers willingly marched straight into the trap. The fear of missing out overrides basic risk assessment. During the pandemic, the terror of being permanently priced out of the middle class erased decades of sensible financial planning, replacing careful budgeting with high-stakes panic buying. Our society often confuses being rich with being wealthy. Being rich simply means generating enough monthly income to cover the staggering payments on massive visible status symbols. Wealth is entirely invisible. It is the unspent capital in a savings account, the investments quietly compounding, and the ultimate autonomy to wake up every morning in complete control of your own schedule and decisions. By treating a primary residence as a high-yield stock portfolio, modern buyers forgot what a house physically is, a depreciating box made of wood, drywall, and shingles that requires endless infusions of capital just to keep the roof from leaking. In the rush to maximize the theoretical spreadsheet value of our homes, we traded away our actual financial independence. This gridlock persists because our current tax code makes it financially advantageous for investors to keep properties empty rather than sell at a discount. Unfreezing the market requires shifting that incentive structure to force hoarded inventory back into circulation. The first lever is a temporary 2-year capital gains tax holiday. By removing the 20% tax on appreciation, the government eliminates the primary financial barrier preventing long-term investors from selling their properties and lowering prices for everyone else. The second lever targets the hidden subsidy of depreciation. Currently, residential investors can write off the value of a house over 27.5 years. Extending that timeline to 39 years shrinks the annual subsidy, making it more expensive for investors to hold on to these homes as long-term rentals. Combining these two adjustments shatters the current incentive structure. If selling becomes cheap and holding becomes expensive, a massive flood of investor-owned homes would hit the market, forcing prices down to a level where people can actually afford to live. But a policy fix only addresses the supply side. We also have to fix our own psychology and redefine the purpose of residential property. Consider a homeowner who chooses to aggressively pay off a 3% fixed-rate mortgage. On a purely mathematical spreadsheet, taking capital that could earn 5% in bonds and sinking it into a low-interest loan is a loss. But gaining the absolute security of owning the roof over your head, free and clear, provides a psychological peace of mind that a spreadsheet cannot measure. A house isn't a retirement fund or a speculative asset. Its primary function is to serve as a stable container for family memories and personal history. If we accept that definition, a nationwide correction in home prices isn't a tragedy. It is a necessary and healthy reset, a process that finally allows younger generations to afford basic shelter, lay down roots, and form families. The ultimate goal of housing is stability. True wealth is the ability to maintain your personal independence long after the market's speculative fever finally breaks.